All right, let's get right into it. Today, we're breaking down Mercury Systems' absolutely pivotal fourth quarter earnings call. Now, this wasn't just some run-of-the-mill report. This was the kind of release that completely changes the story for a company, and it did it, well, pretty much overnight. So, what on earth happened?
Well, this is what happened. The morning after Mercury's call, this was the number that had Wall Street buzzing, a nearly 27% pop in the stock price in a single day. So the big question is, what could management have possibly said to spark a fireworks show like that?
The short answer? They didn't just beat earnings expectations, they completely blew them out of the water. We're not talking about squeaking by here. This was a decisive blowout quarter. And it sent a huge signal to investors that the company's turnaround isn't just happening, it's actually picking up serious steam. I mean, just look at the scale of this surprise. The consensus on the street was for about 22 cents in adjusted earnings per share. But what did Mercury deliver? 47 cents. That is more than double what anybody was expecting. You know, a performance like that doesn't just get a head nod. It forces everyone to rip up their old models and start from scratch. And it wasn't just a fluke on the earnings line either. The strength was everywhere. Revenue shot up almost 10% to $273 million, also beating estimates. And maybe even more importantly, things like adjusted EBITDA and free cash flow, the actual cash the business is spinning off, were both super strong. This tells you the company's health is real and broad-based, not just some accounting trick. Okay, so the top-line numbers looked great, but the real story, the thing that really lit a fire under the stock, is hiding in the operational details. So let's dig in and see how they actually pulled this off. First, though, we gotta quickly talk about a key piece of jargon in this industry, the book-to-bill ratio. All it is, really, is a comparison of new orders coming in the door versus what you're shipping out. So if that number is over 1, it's a fantastic sign. It means your pipeline of future work is getting bigger, not smaller. And boom, here's why that matters. Mercury's book-to-bill for the quarter was a stellar 1.25. That was driven by a record $341 million in new orders. So what does that mean in plain English? It means their backlog, that's guaranteed future work, swelled to $1.4 billion. This wasn't just a lucky quarter. It shows demand is really strong, and all their hard work on efficiency is letting them win bigger and better deals. So, with that incredible backlog as a safety net, management then took the opportunity to lay out their plan for the future. And this is what really sealed the deal for investors, giving them the confidence that Q4 wasn't a one-hit wonder, but the beginning of a whole new chapter for the company. They called it their glide path to profitability. The game plan is to steadily walk their profit margins up into the mid-teens by fiscal 26, and then long-term, they're aiming for the low to mid-20s. For Wall Street, this wasn't just some fuzzy, optimistic promise. It was a clear, believable, step-by-step roadmap to becoming a much, much more profitable business. So, let's recap. You've got a huge beat in the rearview mirror and a crystal clear plan for the road ahead. So how did the market vote? Well, it was a resounding endorsement, a huge vote of confidence in both the results and the strategy. And let's put some hard numbers on that reaction. Before the earnings call, the stock closed at about $53 a share. The very next day, it was trading above $68. That's not just a small drift up. That is an explosive, fundamental re-rating of the entire company based on this new information. And it wasn't just emotional traders either. The professional analysts fell in line, and they did it fast. Take Raymond James, for example. They immediately upgraded the stock to a strong buy and jacked up their price target to $80. That's a powerful signal that even after that massive one-day jump, they think there's still plenty of gas left in the tank. All right, so that brings us to our final section, the next call. We've seen the numbers, we've heard the plan, and we've watched the market's reaction. So, what's our takeaway here at Talk Tickers? What should we be looking for from here? This is really the billion-dollar question, isn't it? The stock has been on an absolute tear for the last year, and now it's capped by this massive earnings surge. So is all the good news already baked in? Or is this just the beginning of the next major move up for Mercury? Look, you could make a bear case. It's pretty simple. Their guidance for next year is a little conservative, and there's always a risk they won't execute perfectly. But honestly, we think the bull case is just way more compelling. The turnaround isn't just a theory anymore, it's right there in the numbers. That giant backlog gives them incredible visibility into future revenue, the margin plan is totally credible, and let's be honest, the whole defense sector has some powerful wins at its ag right now. So for all those reasons, our rating on the stock is outperform. We think the market got this one right.
The combination of a confirmed turnaround and that rock-solid backlog gives Mercury a very clear runway to hit its profit targets. And in our view, that fully justifies this new higher valuation.
This is not financial advice.